Hey, this is Sasha. Welcome to another episode on Hungry for Returns, where I answer your trading and investing questions. And in today's episode, we're going to look at 20% returns. Now, if you have a trading and investing question, go to tradersfly.com. You can go ahead and submit a question by voice, and that way I might be able to answer you in detail. If I know the answer, great. If not, well, I'm going to do my best to give you some direction. So let's take a listen to this week's question, and I'll do my best to go ahead and answer it. So here you go.
Hey Sasha, my name is Arsenio Williams, and I have a question about percentage of return. How can one achieve a high percentage of return, For instance, how can someone achieve the 20% percentage of return on their stocks?
Okay. So let me give you the answer here. We're going to first go to the paper. I'll give you some thoughts and insight on this. So let's go to paper, kind of understand the whole big concept behind it, and then we'll get more into it. All right, so here, if we're looking at high percentage of return and we're looking at kind of 20%, you have to understand, okay, well, are we looking at 20% per day? Are we looking at 20% per week? Are we looking at 20% per month? Or even per year? I'm going to guess you're talking about on the per yearly basis. And the reason for that is because typically, the market, we're looking at 8 to 10% per year as your return on investment. So if you're kind of looking for maybe around 20%, let's talk about this and kind of look at this number as a goal or kind of what we're aiming for. Now, there's a couple different ways to do this, to achieve this. I'll give you a few ideas to think about, but of course you can go ahead and modify it based on your needs. So if we're looking at a few ways to do this, the first one is to look at the stocks you pick. So the stocks you pick will really determine this. This is what most people look at. So hey, which stock is going up? Which stock is better? Number two is the frequency. Okay, so the more trades, think of this, the more trades you do, the higher your percentage of return will be if those are winning trades. So let's say you start with 5,000, that capital grows to now, let's say 5,500. Now you go ahead and you take that capital and invest, and then you make more money and you go ahead and reinvest. So compounding, and now your percentage of return at the end of the year from the starting balance of 5,000 is more. Or it makes it much higher. Now, with the frequency, you have to look at your win-loss ratio. Okay, so if you're winning much more, winning more than you're losing, that's a good thing. And you have to look at your drawdowns. So how much are you losing? So all of a sudden, well, you're making 600 on a trade, 600 on a trade, 900 on a trade, and then you're losing, let's say, only 100. Well, that's great. But if you're losing, let's say, 4,300, well, that makes it a little bit tough. So that reduces your percentage of return. And then, of course, you got to look at, let's say, expenses. Now, expenses, I'm talking about not only these drawdowns, but I'm talking about your commissions, because the more that you trade, the higher these commissions typically. But of course, after a while, you can go ahead and call your broker. So don't be scared to give them a call, and they might be able to reduce it if you're an active trader. But then also your expenses at the end of the day is taxes too, right? So people don't talk about that, but and we're going to leave that part out because everybody's tax situation is different depending on the types of trades that you're doing. But remember that sometimes a 20% return can drop you down to 12% if your tax bracket is a bad tax bracket or you're trading something funky, whatever the case is. Anyway, it can drop you down quite a bit. So remember, the percentage of return of what you can keep in your pocket is also important. And that's the whole point behind proper tax planning. So let's take a look at kind of these situations and go a little more into it. Another one really, that I'll mention here is that you talk about using leverage. And this is kind of more margin or options, which I'll show you. But these are all kind of the things to think about. And then as we look more on screen, you'll get more insight here in just a second. All right, so looking at percentage of return, well, Tesla, choosing the right stocks, this is kind of what most people start out with. Well, let me choose the better stock, right? And the reason is if you choose the right stock, well, you get in it here early on, and the stock climbs, well, you could make, in a couple years, 700% return on your investment. That's phenomenal. That's fantastic. So that's really what people are doing. And if you go Walmart, the same thing. Hey, okay, well, percentage of return. What's my percentage of return? Well, okay, 80, 90% return from that point. Again, that's amazing. So that's really what you're looking at as you look at percentage of return. A lot of people, they look at stock picks. That's usually the easiest form. And then you have to take a look at all these other factors. Hey, well, what's my frequency? What's my win-loss ratio? What's my drawdown? So to increase your percentage of return, you got to go ahead and, well, you can increase the frequency. You can go ahead and increase your win-loss ratio. You can reduce your drawdowns and reduce your expenses. Or, of course, you can leverage more. Now, these, I think, are kind of self-explanatory. I'll talk a little bit more about leverage for those of you that are kind of new. But these, they take strategy, skill, experience to go ahead and make them happen. There's no magic formula to increase your win-loss ratio because everybody's trading differently. They're trading a little bit in a different way. There's no magic formula to reduce your drawdowns. But again, if you have a drawdown that's really big and it affects your profits, well, yeah, that's going to have an impact on your return. So let's take a look at more the leverage part of it, which is kind of what people do. So looking at this Tesla example, if you go ahead and buy 10 shares, I'll share with you, here's 10 shares. Stock currently is about $216.42. If that stock goes to $250, actually, let me go ahead and compare it perfectly for you. See if I can. 156. And this one, capital, let's see how much capital we're going to use. Let's do 10 shares. The stock is 216. So if I bought 10 shares at about 216, I'm going to be spending $2,160. Okay. Now, if that stock goes to 250, I'll make $338. Okay. So what people do is they'll go ahead and they'll take margin. You can go ahead and take things from the bank, right? If the bank's giving you a 4%, 8%, fee on a per year basis, well, of course, if you're making 20% return on investment, you can go ahead and make more money from it. But that's what margin is, and that's what leverage is all about, is that if you use margin, you could go ahead and make more money, or people do that with options. And one of the first ways they do that is they'll go ahead and buy, like let's say a call option. I'm going to go ahead and use the same amount. This is 2,160 that we're spending. So I'll go ahead and let's see if we can spend about that much. 2,195. There we go. So what I did here is went and got an option contract for a call, which basically allows me to make money as the stock goes up. Now, if this stock goes to $250, I make not, when it comes to a stock, I make $354, but here in this case, I would make $2,100. So I'm spending about $2,195, and I get about $2,098. Now that would happen, if it happens immediate, that's how much I make. The downside, of course, with options is, well, if you, I went ahead, had a volatility problem here. So in that case, it would be $2,200. But the issue here is you have this theta problem, which is your loss per day, because to have this contract, to have this option, the choice to buy that stock at that lower price, or to have this contract, you're paying something, and you're paying this contract fee every day. That's the simple way I could explain it for you without getting too technical. But every day you lose money. So in a few days, well, you could be down $273 if that stock doesn't move. Now, if you're just a regular stock investor or stock trader, you could hold on to that stock for weeks, months, or years, and you're not losing money. In this case, in the option contract, you're losing the value of that contract. It's kind of like holding a coupon to go to a baseball game. Well, it's not that you're losing money every day you're holding that coupon, but let's say the game has already started. Well, if the initial ticket was $200, well, now the game already started, you might only be able to sell it for $20. If the game is almost over, you might be able to only get $5, or you might just have to give it away. And that's the same thing here, is that, hey, this contract has a certain amount of value. right? Here it's 67 days. And I got 67 days for this thing to move. If it doesn't move, I lose my full $2,200 and some dollars. But if it does move, I make way more. So that's another way to approach it. Now, some people, they go ahead and trade lighter. They don't go ahead and trade that much, but maybe let's say out of 10 trades, they'll put these things on where they don't spend as much. And now, instead of risking that full amount, it might take them 2 or 3 trades where, hey, this stock, if it does move, well, they risk maybe $800, maybe they risk only $400. You could go ahead and get out of them earlier. But they'll go ahead and make $1,300 on maybe $815. So that's another way to make money. It's not the right way to trade options, I will tell you that. Better approach is kind of doing spreads, something like this. It's way smarter because now you get profits from the theta decay. And that's a better way to do it. So you could go ahead and now, with time, you're actually making money where you're the net seller. So now you could be making $300 and some dollars on, let's say, $2,478 of risk. And, that's another approach. But really, if you look at the basics, you have, you could pick stocks. And then within that, with any kind of trading you do, frequency, the more trades you do, the more you can compound. A win-loss, the more wins you have, the higher percentage return. The lower the drawdowns, the better off you'll be. And if you can reduce your expenses, hey, that's great as well. Then you get into the leverage concept and using margin or options. That's another way to do it. But when you're doing this, you got to really understand, how are you trading options? Are you doing it the smart approach, or are you doing it in the stupid approach? Sometimes some people, they go ahead and they take shots and chances, and they'll do single contracts like this, which is okay. There's nothing wrong with that from time to time, but I wouldn't do this with my full portfolio. But you can do this, and this is how you could achieve a higher percentage of return. And but the smarter approach, of course, if you're doing options, is to do more like calendar spreads, and it gives you more flexibility. If you do like custom trades, well, or let's say I'll go ahead and skew this, and now I go ahead and make money every day that stock stands still, and if it goes up, I still make money. So it creates kind of another winning situation, rather than from a stock. If it has to move up, right? It has to move up. If it moves down, you lose money. If it stands still, nothing happens. And if it moves up, that's when you make money. So only 1 out of 3 of those scenarios you make money. Whereas with kind of an option contract, hey, if the stock stands still, you make money. If it moves up, you make money. If it moves down a little bit, you make money. If it moves down a lot, that's when you start losing money. So anyways, that's kind of what you want to think about if you're looking to increase your percentage of returns and make a little bit more on it. But again, I wouldn't do that, and I wouldn't scale up until you kind of get a little more consistent on your general or basic trades. So I hope this was helpful, gave you some insight and things to think about. And if it did, be sure to subscribe to the YouTube channel if you're not already, hitting that face icon right there, or joining the newsletter list, or even asking a question at the tradersfly.com website. So go over there, do your thing, enter your name and email address, and that way you get insight as we release new future videos. Thanks again, and I'll see you next time.